Well, thank you very much, Fred. It's a pleasure to be here again for one of these sessions. I've now been engaged in economic forecasting for 27 and a half years, and I've learned a few things over the course of time. Now, it is said, and I've found it true, that one learns more from one's failures than one's successes, and I've had a lot of learning opportunities. I've also found over the years that relative to other forecasters, I'm not better than average at forecasting recessions, perhaps a little bit worse than average, and about average during the normal phase of expansion. Where I beat them always is in forecasting recoveries, and that's what we're having now. A year ago, the mood was one of doom and gloom. The doomers were projecting the possibility of another depression, with output continuing to fall through 2011. And the gloomers thought recession would last only through 2009, but that the unemployment rate would escalate to well over 10% by the end of the year, and that growth this year, the average blue chip forecast was for only 1.8%, and my former colleagues at the IMF were down at 0.1%. I was more optimistic at that time, and I think the optimism has so far been justified. The world economy is in a global recovery that began around the middle of the year in 2009 as expected. Some were a little earlier, in particular China and India and Indonesia. Some came on only a little bit later, with the UK finally registering positive output growth only in the final quarter of last year. The bounce back in some dimensions was really spectacular. Industrial production shrank at annualized rates of 30, 40, and 50% for the first few months of last year, and then came back at annual rates of 30 and 40% later in the spring and summer. And that recovery of industrial production and world trade sort of gave everybody a boost. Now, looking ahead, I forecast that global recovery is going to continue. In the emerging markets, I think it's well established, and provided the industrial countries don't fall out of bed again, which I think is highly unlikely, I think the emerging market economies will continue to enjoy good growth both this year and next. And my forecast for them as a group at about 6% is now very similar to what the IMF was forecasting as of January. I came up 1.3% from a year ago. They came up about 3.5%. So now we're very close together on the emerging markets. As Fred indicated, Arvin and Anders are going to say more about Asia, Central Eastern Europe, and the CIS. Let me just mention on Asia that my colleague Nick Lardy recently produced a policy brief for the Peterson Institute on the sustainability of China's recovery from global recession, which contains a great deal of useful information and insight. And I derive inspiration from that. I predict that China's growth this year will reach 10%, but it may slow modestly in 2011 to 9%. India, which had a bad monsoon last year, is going to take down their growth rate a little bit for 09 and 10, but I expect them to come back strongly in 11. And the rest of emerging Asia should continue to do reasonably well. Latin America, also in the past couple of quarters, has begun to show considerable strength in its economic recovery, led by the Brazilian economy, which remains, I think, in very good shape overall, and likely to turn in something like 5% growth performance this year and close to that next year. Mexico has also turned to positive growth, and contingent upon the kind of expansion that I foresee in the United States, the Mexican economy should also grow strongly this year and next. Most of the rest of Latin America will probably do pretty well, with Venezuela in a bit of a mess and some significant growing concerns about the situation in Argentina. But overall, Latin America should turn in a pretty strong growth performance this year and next. And the Middle East and Africa survived the global recession really quite well. And with the recovery of commodity prices, I expect to see stronger growth going forward. Where the major concern is about the strength of the recovery continues to be in the major industrial countries, in Japan, Western Europe, and the United States. Produce a little table here to illustrate the current forecasts for growth in the major industrial countries. Mine is at the front, where it should be, and we have the IMF, the Economist poll, the consensus, and blue chip. And these are the average forecasts. The Economist, the consensus, and the blue chip report ranges around those averages. As you can see, forecasts for the United States have now come up to around 3% on a year-over-year basis, and I expect the IMF will be there by the time the WEO is released later this month. I'm moderately stronger at 4%, and I'll look at some of the details of what I expect. I'm also stronger when we go down to the bottom half of the table. Think that growth of around 4% is going to continue in the United States. And again, I'll return to that at the end of the discussion in 5 or 10 minutes. What about Japan? Well, Japan suffered a very deep recession in the global downturn as their external trade collapsed and domestic demand weakened. Real GDP in Japan during the recession dropped almost 7%, the largest downturn in Japan in the post-war period. Of course, before they had growth rates of 8 or 9%, so a downturn meant something different. But far deeper than the recession at the beginning of this decade or the recessions in the 1990s, and even deeper than the 75, 76 recession after the first oil shock. Now, forecasts for Japan envision a very weak recovery. Potential growth in Japan is quite low because the population and the labor force are shrinking. Productivity growth is probably about the same as in the United States, on the order of 2%. So potential growth in Japan I would assess to be at stronger than 1%. I would think perhaps as high as 1.5%. And these forecasts say that Japan is not going to grow any faster than potential. I don't believe it. When you have a recession, it tends to be followed by a recovery. And I think that a recovery will take hold in Japan as well. Now, it will not be a spectacular whiz-bang recovery. At least that's not the center of my forecast. But to forecast continued putzing along at no more than the potential growth rate is simply not consistent with the history of business cycle behavior over the past century in any market-oriented economy. Turning to Europe, here I have the euro area and the UK, and you can see that other forecasters anticipate that growth in the euro area this year will be, around 1.2% as an average. That's well below the potential growth rate in the euro area, which I would put at 1.75 to 2. And in the UK, the growth forecasts are only slightly higher at about 1.2 to 1.3%. Things are anticipated to pick up only barely in 2011 in the euro area, and perhaps slightly more in the UK. So here we don't have continued recessions, but we have economies which are going to grow below their potential, or at best in line with it. So there's no business cycle recovery. I think that's probably wrong, and so I have my forecast above those of other analysts, and indeed at the top of, or a little above the top of the range of other forecasts. Now, there are, I think, good reasons to anticipate that Europe will not have a whiz-bang recovery, as we would normally expect following a very deep recession. There are a number of things that are going to restrain the recovery in Europe, including the United Kingdom. The problems with the common currency, with some countries that are in economic difficulty clearly having overvalued currencies, the financial difficulties in Greece and potentially other countries. There's a long list. It's also been a general tendency for European recoveries to be less robust than in the United States. The so-called hysteresis effect, the tendency for the unemployment rate to stay up after it's gone up rather than come down, has clearly been much stronger in Europe than in the United States in the past 30 years. So there are good reasons not to anticipate 4 to 5% growth in Western Europe at this time. But I think we should be anticipating a more vigorous recovery. Part of the reason why forecasts are so low is that the data for the last couple of quarters, which have been reasonable in the United States, have been quite weak in Europe. And there's a tendency for forecasters to project whatever the most recent data are forward. Well, I think there's a good reason why the European recovery has lagged behind the recovery in the United States. And that is that we entered the great global contraction in the final quarter of 2008 and the first quarter of 2009 in very different condition. In the United States, the recession started earlier, with domestic demand contracting in the fourth quarter of 2007 and continuing to contract through 2008. In the euro area and the UK, we had fairly vigorous expansion through the first quarter of 2008. Policy behavior was very different. The Federal Reserve began easing U.S. monetary policy in September of 2007, had cut the funds rate by 100 basis points by the end of the year, and cut it a further 225 basis points by June of 2008. The European Central Bank was still tightening in the face of rising inflation rates, with the last tightening move occurring in July of 2008, just before the great global financial panic. So we were already in easing mode in terms of policy. We had already made a number of the adjustments downward in residential investment and so forth that were clearly needed in the U.S. economy at the time the global financial panic struck. When it did strike and global credit markets became highly dysfunctional, everybody went down the tubes, basically. Us, Western Europe, Japan, most emerging market countries, other industrial countries, what have you. But coming out of the recession, we, I think, have had the advantage that the lag in monetary policy, its effect of easing on the economy, has already been absorbed before the great global financial panic, so that coming out, we weren't working with that heritage. Whereas, as far as Europe is concerned, they are still feeling some of the after effects of much tighter economic policies that were in force just before the crash really happened at the beginning of the fall of 2008. Hence, my conclusion, the European recovery is lagging behind the United States by a couple of quarters. But I expect that it will be gathering strength about now. And my forecasts modestly reflect the expectation that we'll get growth that is at least a little stronger than potential growth in the euro area and the UK going forward. Turning lastly to the United States, I sort of updated my forecast scenario for what's going to drive U.S. growth going forward to include 2011. And I always put together a table, in fact more detailed than this, of annual and quarterly numbers just to make sure that my forecast, in fact, adds up in some sensible way. It never actually turns out, even if the overall number is nearly right, the components almost always look somewhat different. We want to check to make sure that you got at least a reasonable story. And basically, the story for 2011 in terms of the magnitude of GDP growth is about the same as for 2010. I see a little bit of a slowdown on a fourth quarter to fourth quarter basis. And that's mainly because we are getting or have gotten the surge in inventory investment that normally accompanies a business cycle recovery. And there's not going to be anything more from that source, I don't think, in 2011. So the expansion is therefore going to need to be dependent upon other things. I think consumption spending will continue to grow. There's no doubt that most recently in March, we had a blowout month as far as the rise in consumption spending is concerned. I don't think we'll have too many of those. Consumption spending will grow less rapidly than GDP, but the American household will spend more as its income rises, though it will grow less rapidly than GDP grows in percentage terms. I expect gross private domestic investment to continue to turn in strong numbers, with business investment which in equipment and software has already made the turn, and I think it will continue to show significant strength. Investment in non-residential structures is still shrinking. I expect it to turn positive by 2011. And residential investment, which peaked at $780 billion in 2005 dollars at the end of 2005, will, I think, get back to over $500 billion, but still be $250 billion below its previous peak by the end of next year. So there's a lot of room for private investment to come back, and this will be true even after the end of 2011, according to my forecast. I'm not expecting big gains in government spending because state and local governments are going to remain under pretty severe pressure despite substantial assistance coming from Washington. I am anticipating that the U.S. trade balance will deteriorate, but only modestly, because our growth is not that much stronger than growth in the other industrial countries, particularly in 2011, according to my forecast. And the emerging market countries are growing significantly more strongly. Also, in contrast to what was true in the expansion of the first half of the 1980s, the dollar is not super strong and getting stronger. So I think our trade balance will subtract a little bit, but not enormously from growth. Now, the final topic that I want to mention is the peculiar things that have been going on in the U.S. labor market. We have seen unemployment go up from 4.5 percentage point unemployment rate to just over 10%. I think 10.1 was the peak last October. I think we've seen it and it's coming down. But still, the increase in unemployment was significantly larger than we would expect given the size of the business cycle output loss of 3.6%. There also was an unusually large increase in long-term unemployment, which you can see at the bottom. Overall unemployment went up 93% December 07 to December 09. Long-term unemployment went up 361%. Long-term unemployment always goes up in a deep recession, but not proportionately this much. Another interesting feature that I draw attention to is when we look at employment losses broken down by age group and educational attainment for those over 25, that the drop in teenage employment has been enormous. Now, normally you expect to see in percentage terms teenage employment drop 3 to 4 times the drop in older adult employment. But 6 times is sort of beyond the normal range of results. What's going on here? Well, I think part of it is something that they don't like to mention in Washington, particularly not in the White House and in the Democratic-controlled Congress. We had a 40% increase in the minimum wage, beginning with a 60-cent rise in mid 2007, which probably had little effect because it affected very few workers and labor markets were tight, so employers didn't have many alternatives to hiring teenagers and other minimum wage workers. But then another 75 cents in mid-08 when labor markets were much looser, and when labor markets were sort of at the maximum degree of slack, another 75% in mid-2009. And as a consequence, the firms can, if they're looking for additional employees or looking to let go of employees, teenagers and other minimum wage workers are not all that attractive in view of the fact that there are plenty of alternatives to employing them, whose wages have not been pushed up by the increase in the minimum wage. Now, of the 8 million loss of employment in this 2-year period, the rise in the unemployment rate is not a big deal. But I think it might account for as much as 500,000 of the drop in employment. The other thing that is, I think, noteworthy from these figures is the way in which the loss of employment is distributed amongst the different groups. Note that those with a college education and over had no loss of employment. A small, not statistically significant, gain in employment. The next highest level of efficiency of workers, presumably, those who have some college education, that dropped 4%. Those who have a high school degree dropped 8.2%. Those who have less than a high school degree dropped 11.7%. So employment has been contracted in those components of the labor force that are relatively less productive. That's one of the reasons, not the only reason, why we've had such strong productivity growth numbers, particularly in the last couple of quarters. But even in the recession, we didn't see the loss of productivity that often accompanies a recession. And that's because the average productivity of the workers who remain employed has gone up as the workers who have lost employment have been amongst the relatively less productive. The other side of the coin here is that as the business cycle recovers in expansion and as GDP grows, the people we're going to be re-employing are going to be less productive on average than those who have remained employed. As a consequence, productivity growth is likely to slow going forward from what we've seen recently, and unit labor costs, which have declined in some recent quarters, will probably begin to rise. On the other hand, it also means that with real GDP growth of a little bit over 8% that I forecast between the beginning of this year and the end of next year, the employment generating effect of that gain in real GDP is going to be more substantial as we need to re-employ workers who are relatively less productive. So I'm forecasting, with my growth forecast, that we'll gain 5.5 to 6 million in increased employment over that 2-year span, taking the unemployment rate down to 9% by the end of this year and 8% by the end of next year. Now, before we roll out the champagne and celebrate, let me recall that full employment is probably an unemployment rate around 5% or something like that, and it's going to take a number of years after 2011, even if the economy continues to enjoy moderately robust growth, to work the unemployment rate back down to something we might reasonably refer to as full employment. So we are in recovery. It's stronger, I think, than many forecasters understand and appreciate, but it is not rapidly taking us back to full utilization of resources in the U.S. economy or in other industrial countries.